Hello everyone. Today's topic of discussion is current assets. Now we have already discussed in the previous video the working capital ratio, which involved two terms, basically the current assets and the current liabilities. So it's imperative that we start discussing about them and exploring more into it. So first of it is the current assets. Now what are current assets? So current assets are basically the company owned assets that can be converted into cash within 1 year, right? So this means that a company can quickly convert those assets into cash within 1 year, and they can complete their short-term obligations with it, right? So anything above 1 year that would take more than 1 year to convert into cash won't come under current assets. They will be assets, but they won't come under current assets. That's why you will see in the balance sheets, usually whatever comes under current assets can also come under long-term assets in their balance sheet, only because of the time frame that's different, the liquidity that's different. So current assets basically also defines the short-term liquidity of a company and how fast it can generate cash and how fast it can get rid of its short-term debts or short-term obligations, and all those things. Obviously also work on working capital and all those things, right? Now what comes under assets? First thing that's very easy to understand is the cash and cash equivalents come under short-term, basically current assets. Market securities that can again be converted into cash within 1 year will come under current assets, but mostly cash equivalents and marketable securities that can be liquefied within 3 months should be considered, because they are faster to convert into cash, right? Then you have account receivables. Receivables are basically the pending payments that you know that will come back to you, that are due and will come back to you within 1 year of time. Your inventory. Now inventory is again subjective. There are some companies that have an inventory that they know that will sell within a year, and then there are other companies whose inventory they know won't sell within 1 year. So inventory which can be sold within 1 year of period of time will come under current assets, the other one won't, right? Prepaid expenses. Now prepaid expenses are basically the expenses that you have already paid for in advance. These can be premiums, these can be rents, these can be taxes, so you have already paid them. Now how prepaid expenses are considered into current assets is because even though that money is not with you, but that money has opened the gateway for you to expand and take care of other obligations, right? So your expenses for that year for that particular things are already done. That we don't have to take care of that anymore since you have already done that. That's why they indirectly come under current assets, right? Then obviously the other one is the short-term investments. So investments that are really short-term and they can give you the returns within the same year are considered to be current assets. Now in terms of current assets and basically in terms of short-term investments and marketable securities, you need to understand one more thing. If you are selling them at a loss, basically if those securities and short-term investments are not giving you the same result or the same value at which you bought them, then they should not be considered under current assets, because that money is completely lost, right? You haven't gained anything from that. So that should also be another point of consideration when you talk about market securities and short-term investments. They should at least gain when you sell them, if and when you sell them, basically. So all these comes under current asset. Now what's the basic formula for current asset? Basically you add all these and you get your current asset. Not all companies will have everything. Some even merge some things together, but these are the major things that you will find in their balance sheet, right? Another small point of discussion is what are non-current assets. So non-current assets are basically the reverse of current assets. That is the assets that cannot be converted into cash within 1 year, right? Now these are very easy to understand. These can be property, plants, right, machinery, buildings, long-term marketable securities, and long-term investments. So all these obviously can't be converted into cash within 1 year. That's why they are non-current assets, right? Now let's take an example of two big companies, one of them being Walmart. Now according to the financial year 2021 of Walmart, they told that they have the current assets worth of 90 billion. Out of that, they had cash and short-term investments of 17.7 billion. They have account receivables of 6.5 billion. They had inventory of 45 billion, and other current assets, basically whatever we mentioned, that was worth 21 billion, right? Now important thing to note is they have kept inventory as at 45 million. 50% of their current assets are their inventory. But looking at the scale of Walmart, the type of infrastructure they have, the type of customer base they have, they know that they will sell 45 million billion worths of inventory within 1 year. So that's really huge for a company like Walmart. Another example to compare between both is, let's say, Microsoft. So Microsoft, again, for financial year 2021, they had a much larger current asset of 184 billion, right? Their cash and short-term investments was 130 billion, very high than Walmart is. But you will see their inventory is just 2.6 billion, nothing in comparison to Walmart. Why? Because Walmart is completely B2B, B2C, but they are selling the products on the front end, and Microsoft has too many companies, too many services, too many products to cater to, and taking care of physical inventory is just a small part of it. Other than that, there are a lot of things that they take care of. That's why the physical inventory is worth so less, right? Also, it depends upon what you are selling, what are your number of SKUs, what are your average price value, that all those things cover under that. Other current assets of Microsoft were 13.4 billion, but overall you see the cash, Microsoft has cash and short-term investments at a high 130 billion, whereas Walmart has inventory on high, right? So your companies need to prioritize and see their market structure, see their performance, and then they analyze what they need to hold more, what they need to hold. Obviously, Microsoft also, why the cash and short-term investments are so high is because they usually acquire a lot of small companies as well, right? So, and they're into software business along with the computer peripherals and all those things, mobile industry, right? So, yeah. So I think all this was a very small topic, but it was very easy to understand. But again, after current assets, we should look into current liabilities also. We'll discuss that in further videos. We'll discuss liquidity. Then we will discuss the various marketing ratios that actually help in investments in these current companies. So what are the ratios that investors look into before investing into a particular company? They can be current ratios, quick ratios, cash ratios. We'll look at all that. Then we'll also look at what are liquid and illiquid assets, right? All these points are important. We'll definitely discuss these in the future video. Yeah, but for now, I think this topic is understandable to you. So yeah, please like, share and subscribe, and take care of yourself. Thank you.